Now, I do want to broaden out our conversation, talk more macro about the broader environment amid the government shutdown. Welcome in our next guest, Ed Siddell, who's the CEO and Chief Investment Advisor at EGSI Financial. So, Ed, let's just start with a broad thought on market performance, particularly in the last 2 days since we began this government shutdown.
You know, really what it's showing us is that investors are resilient. The markets are resilient. The markets are down a little bit today, but obviously they were up at the opening. They finished high yesterday. And really, we believe that investors in the markets are looking at this as really just a short-term bump in the road, and eventually things are going to get back on course.
And as far as the government shutdown, in terms of the length, are you concerned at all about the shutdown itself, or do you only become concerned if it looks like it's going to be longer term?
Honestly, we're not concerned at all. We believe that it's probably not going to last more than a couple weeks, maybe as long as 4 weeks, if that. When you look at what the current administration is looking at doing, they're looking at trimming some of the fat and getting rid of federal employees and costs and other projects that really is just a lot of pork in the overall budget. So I think short term, there's going to be a little bit of pain, but long term, it's really going to benefit the country.
So with that said, some of the concerns that we've heard as we've been, in the lead up and now 48 hours in is concern about how this could potentially affect GDP overall with some of these potential mass firings and also if it will affect consumer spending. Do you have any concerns there?
In the short term, sure, absolutely. But with the jobs numbers that were supposed to come out tomorrow, there's going to be a delay on that. So the feds are depending on a lot of these numbers from the Bureau of Labor and Statistics, excuse me, that aren't going to be coming out because of the shutdown. So the impact that's going to have on interest rates at the next Fed meeting, those are the impacts kind of near term that's going to affect the long term that we're really looking at. As far as consumer spending, again, we believe that it's really not going to have that big of an impact because it's really not going to affect most consumers going forward.
And Ed, you mentioned the Fed and then the absence of data in this data blackout because we're not getting that jobs report. We didn't get any of the unemployment claims number today. How does the absence of that data, if we don't get it ahead of the October meeting and all we have to work off of is the ADP data that we got yesterday, how does that potentially impact the Fed and its rate cutting decisions going forward?
Honestly, you could probably just put a hold on it if there's really no data, because as we know, Jerome Powell has made it very clear that they're hanging their hat on the jobs reports, as unreliable as they've been over the last couple of years, and just even most recently. However, having said that, I think they're not going to make a decision until they actually have some data. So if we do have that blackout, they're probably just going to put everything on hold. I don't think they're going to make a decision.
And as far as some of the Fed speak that we've gotten, in the wake of our last rate cut, we've heard from quite a few of Fed officials, it's some with very differing commentary. What are some of your takeaways and who did you think had the most impactful thoughts or may potentially be the most influential in the room?
Well, when you look at Goolsby's interview just a couple days ago, he was actually talking about he was in the camp of lowering rates at least 1%, if not more. And then you had Murin talking about, the economic strain and why we need to lower rates. And he was at the full other end of the spectrum saying it should be as much as 2%. And I think that might be a little much. But I do believe that we do need to lower rates going forward because the economic impact that it's going to have, not just on the national debt and servicing that debt, as expensive as that is, but on small businesses all the way across the country. That is the lifeblood of America. And so the debt service on small companies, if we can lower that debt service, it gives them the ability to expand and hire and further grow the economy.
And so with some of this uncertainty, we've seen this massive rise in gold. Every day I'm talking about another new all-time high. I'm looking now at the chart under pressure a bit today, but still hovering near an all-time high that we certainly could reach by the end of the day with what we've seen from its performance of late. What are your thoughts on gold? Are you bullish here? Can this rally continue as long as we still have this uncertainty?
Absolutely. We see gold going north of 5,000, over the next year, maybe even a little bit higher. And the reason, there's a devaluation of the U.S. dollar that has to do with tariffs and encouraging people to buy U.S. made, right? Because then imports are more expensive. But when we look at precious metals as a whole, not just gold, but also silver, silver is also very undervalued. It's way off of its high. We see gold with AI and not just AI, but as far as military weaponry going forward, we see silver being, north of 200 an ounce over the next couple of years.
Yeah, and we've certainly seen a meteoric rise for both of the metals, over the quarter at least. But you have some stock picks as well that I want to dive into. The first one, API Group. Walk us through this choice.
Yeah, I really like API Group. APG is a great stock. It is fundamentally strong. They have a strong balance sheet, a lot of cash on hand. And even in the downturn during COVID, they performed very, very well. We see that going north by another at least 20% over the next 12 months, especially as the economy continues to grow and turn around. Lowe's for the exact same reason. We see Lowe's going above 280, north of 285 over the next 12 months as well, because as the economy continues to grow and spur on, there's going to be a lot more home improvements, a lot of DIYers that put things off. They're going to be more comfortable. The income is going up, savings are going up, and so they're going to do things more in their own home for home improvement.
And I have a question about Lowe's. We had a guest on the show earlier this week that had Lowe's in the big three, was bearish on Lowe's for the exact opposite reason. Concerns about consumer spending and the potential of a government shutdown forcing consumers to tighten their wallets. And the first thing that goes, we've often seen, are these home improvement projects. So you think the opposite, the people who've put them off are going to head to Lowe's to start fixing up their homes now?
Well, absolutely. So in that short term, I would tend to agree with that. All right, that may be a possibility, but then that provides a really good buying opportunity. So if Lowe's does dip down, again, long term over the next 12 months, we really see that going north of, like I said, 280, 285. And the reason is, as the economy is going to continue to grow, people are going to have consumer confidence, cash on hand, and they are going to do those home improvements because the shutdown is going to be temporary. It really is just going to be a bump in the road.
And that 280, 285 right now, we're trading 247, so some considerable upside there if we hit those numbers. But appreciate you being with us to walk us through some of your picks and also for that macro conversation about the shutdown. That's Ed Siddell, the CEO and Chief Investment Advisor of EGSI Financial.